Hello, and welcome to Street Smarts. Today we'll be focusing on a new video series on Canada's real estate investment markets. Canada's investment market continues to be dynamic. The low interest rate environment, substantial equity and debt capital that needs to be deployed, and a growing U.S. economy all suggest this resilience will continue for some time. Our global investor clients are increasingly looking to me to identify opportunities in a scarce Canadian asset market. This may require looking at suburban or urban asset types or classes they may not have looked at in the past, perhaps development or at least risk profile they may not have accepted previously, or simply accepting lower prime yields. But this is not a market where a rising tide lifts all boats. Investors are very focused on their portfolio objectives, their risk profile, and not all properties are going to fulfill that criteria. I'll turn it over now to Nick Yanovski. Nick's going to delve deeper into the GTA investment market.
As an investor, here's what I can tell you about the Toronto investment market. We see continued demand across all asset classes. Those assets that are located along public transit corridors are of particular interest to investors. Yonge Richmond Centre just sold for a 5.4 cap. Office buildings with a substantial retail component are trading for even lower cap rates. We are a country that is significantly under-retailed. 150 Bloor Street West at the corner of Avenue Road and Bloor just traded for a 4.6 cap, or almost $1,000 per square foot. What's interesting about that trade is that a group from Spain came to Canada looking for a prominent asset on one of two streets in this country. 150 Bloor came up for sale, and they acted extremely quickly to acquire that property at a record-setting price for the Bloor Street market. Foreign investment is another very hot topic in our city. Toronto is seen as one of the foundation cities of the world. Where we used to see capital coming in from Europe, from the Mideast, from Hong Kong, we are now seeing money come in from mainland China. Private families are looking to acquire real estate. Institutional investors that have recently had their restrictions lifted by their government are now able to acquire properties outside of China. Where these institutional investors would look for trophy, stable properties in the past, they're also looking at development sites. Greenland Group, for example, just acquired a 1-acre parcel at King and Blue Jays Way for $156 per buildable square foot. Let's not dismiss domestic investors. The corner of Yonge and Bloor just sold for a reported $200 per buildable square foot. Condominium development in the city continues to be strong. Developers are looking for new sites, well-located sites along transit corridors, and are willing to pay new historic highs. What's interesting as well is that institutional investors are also getting into the residential development game. However, they are looking at building multi-residential rental buildings. They're able to compete on price with condominium developers in certain markets, certainly along those transit corridors. We haven't seen a significant new stock of rental buildings in the city for almost 40 years. This is truly an exciting time to be in the real estate market in Toronto.